Hi everyone, welcome to this course in which I'll be teaching you derivatives. So I'll be walking you through chapter by chapter, and the book that I'll be referring is John C. Hull. John C. Hull is called the Bible of Derivatives. So I'll be walking you through chapter by chapter so that you understand what is derivatives. So in this video, I'll basically tell you what is derivatives, then some of the terms used in derivative, that is what is exchange, what is over the counter, then what are different types of derivatives, their characteristics, their payoff diagram, and then maybe I'll also walk you through some of the examples of how to use derivatives or how derivatives are used. And then in the end, I'll tell you some of the terms that are used, such as hedgers, speculators, and arbitrage. So I'll be helping you with understanding all these different terms. So let's understand what is a derivative. So what is a derivative, right? So a derivative is nothing but it can be defined as a financial instrument whose value is derived from the value of the underlying asset. Okay. So in this case, in the world of finance, right, the underlying assets can be stocks, bond, commodities, currencies, interest rates, or market indices, right? So I'll be walking you through some of the financial example, and then I'll give you a non-finance example so that you can understand the differences clearly. So what is a derivative, right? A derivative is defined as a financial instrument which derive its value from the underlying asset. Now, the underlying assets can be, so the underlying assets can be stocks, bonds, commodities, currencies, interest rates, or market indices, right? So basically, if you see derivatives, nothing but it is deriving its value from a underlying asset. So I'll give you a non-finance example so that you can understand this concept very clearly. Let's take an example of banana juice, right? Or any juice for that matter, orange juice, banana juice. Now, if you see banana juice, right, what will be the underlying, right? Banana, right? The underlying will be banana, right? So if let's say the prices of the banana, right, it increases, it is of course that the price of your banana juice will also increase, right? And similarly, if in a given year there are a lot of bananas that has been produced, right, so the price of banana will decrease, and similarly the price of banana juice will decrease. So if you see in this example, banana juice is the derivative, right? In this example, banana juice is the derivative because it's deriving its value. This product is deriving its value from a underlying. So in our case, banana will be the underlying. Okay. So you can take like this. You can take any multiple examples. Let's say some kind of let's say orange juice, right? So in this case, what will be the underlying? The underlying is nothing but your oranges, right? So if in a given year the prices of orange is high, or let's say if in a given month the price of orange is high, it is for sure that the juice that you will get, the price of that will also be high. So in this case, the derivative is nothing but our orange juice, and the underlying is nothing but it is orange. Similarly, in the world of finance, right, derivative is nothing but it's deriving its value from the underlying. So underlying can be what? In our case, it can be stocks, bonds, commodities, currencies, interest rates, and market indices. So this is what is a derivative, right? Now, so there are some common terms which are used in the world of derivative, and you'll see most of the risk managers or traders talking about this, right? So what are the terms? One is exchange, and the other term is OTC, right? So OTC is referred as over the counter. So these two are basically the types of market. These two are the types of market where derivatives are sold, sold and bought. Okay, so let's understand each of them. What is an exchange and what is an over the counter? So exchange, right? So exchange is nothing but it refers to a marketplace, or you can say it's a platform wherein various financial instruments such as stocks, bonds, commodities, derivatives, currencies, they are traded. So it basically provides a centralized venue wherein buyers and sellers can come together and they can execute the transaction. So an exchange refers to a marketplace where various instruments. Now, what can be the instruments such as, if you see, stocks, bonds, commodities, currencies, or you can say any kind of derivative, any kind of derivatives are traded. So basically, it provides a centralized venue where buyers and sellers can come together to execute the transaction. So this is what is referred to as exchange, right? Now let's understand some of the key features of exchange, right? Let's understand some of the key features. First is standardization. So whatever instruments that has been traded over the exchange, you will see those are standardized contracts. So when I say standardized contracts, I mean, they are standardized in terms of size, expiration date, their specification, which in turn simplifies your trading activity. So standardization basically means contracts are standardized in terms of size, expiration date, and other specifications, which in turn simplifies the trading activity. Now, okay, so this is like the first feature, right? So the second feature is regulation. Regulation, okay. So if you see, all the like these markets are heavily regulated, providing greater transparency, and it often reduces the counterparty risk. So the exchange market are highly regulated, or let's say you can say are heavily regulated, providing greater providing greater transparency, providing greater transparency and this in turn reduces and in turn this in turn reduces the counterparty risk. Right. Now the third is the clearinghouse. The third feature of exchange is the clearinghouse. So what is a clearinghouse? Basically, a clearinghouse acts as an intermediary between the buyers and the sellers, guaranteeing the performance of the contracts and therefore reducing the default risk. I'll give you an example also. So basically, if you see, so whenever you see over an exchange, right, it's not a the transaction doesn't happen A to B. Let's say this is party A, this is let's say party B. The transaction does not happen like this. Instead, you need to there's a clearing house which basically settles all the which helps all the buyers and the sellers to execute the contract. So this is how the structure is, right? So basically, what is a clearinghouse? So basically, a clearinghouse is nothing but a clearinghouse acts as an intermediary, acts as an inter intermediary between the buyer and the seller, making sure that the contra- contracts that the contracts are obligated. Right. I mean, see, it should not happen. Okay, I said, okay, I want to buy the asset, and the other party says, okay, I want to sell the asset, but then I back out, right? So it basically makes sure that it maintains the transparency, and also helps to execute the contracts and make sure it's a fair deal. So this in turn, this will reduce the default risk, right? Okay. So this is the third feature. Now moving on to the last feature, which is liquidity. So if you see over the exchange, you will see highly liquid instruments because of large number of participants and because of the standardized natures of the contract. So over the exchange, instruments are liquid, and and this is due to large number of participants and the standardized nature of the contract. Okay. So that is all about, what is an exchange. It's nothing but a marketplace, right? As I said, it refers to a marketplace where various instruments are traded. So it basically provides a platform wherein buyers and seller can come together and execute the transaction. Again, some features are standardization, contracts are standardized. It's a highly regulated, regulated environment. There is a clearing house between the parties. So buyers and sellers, there's an intermediary between the buyers and the sellers, and the last is of course the instruments are liquid, and this is because of the large number of participants and the contracts are standardized. Similarly, let's understand what is over the counter. So this is so exchange is one place where the derivatives are traded. So the second place is nothing but over the counter market. And this is the second type of place wherein derivatives are traded, right? So the over-the-counter market refers to a decentralized marketplace wherein financial instruments are traded directly between the two parties without the involvement of a centralized exchange. So, so if you see this in contrast with the exchange, OTC markets are typically less formal and they operate through a network of dealers and brokers. So the over the counter. So okay. So OTC is referred as over the counter. Okay. So OTC is referred as over the counter. So I'll just use OTC. Okay. So the over the counter market refers to a decentralized marketplace. Decentralized marketplace where financial instruments. Now we all know what are the financial instruments such as bonds, stocks, right? Stocks, bonds, currencies, commodities, derivatives, right? Etc. Etc. Right? They are traded between two parties without without the involvement of a centralized exchange. This is what is over the counter market. So if you see, if you take this in comparison with the exchange that we discussed above, so OTC market are less formal and operate through a network of brokers and dealers. Perfect. So now let's understand some of the features of over the counter, right? How we discuss for exchange, let's understand the same for over the counter. Okay, first is customization, and this is like the most important. See, we know that over the exchange the contracts are standard, right? But if you come to over the counter, the contract the contracts can be tailored to meet the specific needs of the parties involved. And it can be anything. It can be your, if you want to change your size, if you want to change the maturity, if you want to change the underlying assets, right? So basically the contracts in over the counter, they are highly customizable. Okay. So in this, contracts can be tailored to meet the specific need of the parties involved. And what can be, what can be altered is including the size of the contract, the maturity can be changed, the underlying assets can be changed, the underlying, and like this there are different different terms and conditions that can be changed. So second is regulation. If you see, we discussed, right, that the over the counter is highly regulated. But if you see, the over the counter markets are less regulated, so which can lead to less transparency compared to the exchange traded market. So over the counter markets are less regulated as compared to exchanges. Okay. Then we have our third point, which is counterparty risk. See, if you see, the way exchange work was, there was a counterparty involved, right? There's a counterparty, or let's say, if you see this, there was a clearing house involved, right? There was a clearing house involved in an exchange, but this is basically for exchange, right? But if you see how deals are done in over the counted, it is more of this sort of thing, basically we have a party A, we have another party B, so the transaction happens directly, it's A to B, so there is no clearing house in between. Okay, there is no clearing house in between. And this arrangement is for over the counter. Okay, so it's because now if you see, because there is no clearing house, that's why the counterparty risk, see, we know that, okay, let's, if B it means if it did not obligates, if a party B does not obligate the agreement, right? So the clearinghouse will make sure, okay, whatever A has to get, party A will get the same. But it is not the same with this over the counter. If B defaults, the loss will happen is more for A. Okay. So in this, if you see, the counterparty risk is high. Okay. The counterparty risk in over the counter market is high. Okay. And why we have a higher counterparty risk? Because the contracts are not guaranteed by the clearinghouse. So the risk depends on the credit worthiness of the parties that are involved in the transaction. Okay. So high counterparty risk is because high counterparty risk is because the contracts are not guaranteed by the clearinghouse. The contracts are not guaranteed by the clearinghouse, and therefore the risk depends on the credit worthiness of the parties involved. Okay. So as you might understand, right? I mean, if you see exchange versus over the counter, in exchange, you'll see all the derivatives contract. Those are standardized contracts. Exchange is highly regulated. There is less counterparty risk as opposed to if you see over the counter. In this, the derivative agreements are more customized depending on the needs of the party. It's a less regulated environment. There is a higher counterparty risk. Okay. Okay. So now let's move to what are the different types of derivatives. Now let's understand what are the different types of derivatives that are traded in the financial market. And when I say in the financial market, I mean both exchange and over the counter. And this is one of the very famous interview questions. Can you tell what are the different types of derivatives that are traded in the market? There are there are four types of derivatives that are traded in the market. There are four types of derivatives that are commonly traded in the market. So what are they? If you see, they are forward, or let's say future, forward, options, and then we have swaps. So these are, some of the common derivatives that are traded in the market. We'll understand each and everything in detail, okay? But this is just a note, okay? This is just a note that futures and options, if you see, futures and options are traded at the exchange. And I'll basically tell you, what is future forward. But this is just a note, okay? If you see forward, swaps, and over the counter options. So options are traded, both in the exchange as well as at the over the counter. But if you see, for futures are only traded at the exchange, and forwards and swaps and options are traded over the counter. Okay, this is just a note. But let's understand what is a future contract, what is a forward, because these are different derivatives with different properties. So let's understand each of them. First, futures. So some people say this as a future contract, some say as okay, future. But what is it? So let's say futures or nothing, but we can also say future contract. So if you see, a future contract is basically a standardized financial derivatives that obligates the buyer to purchase and the seller to sell an asset at a predetermined future date at a predetermined price. Now, if you see, okay, futures, if you see a future contract is a standardized agreement that obligates. This is very important, okay? It's an obligation. Okay, this is like very important term that obligates the buyer to buy and the seller to sell the underlying asset, or let's say, we can also say buyer to buy and the seller to sell the derivatives, right? At a predetermined date, at a predetermined date and at a predetermined price. So this is what is a future. Now, since we know it's a standardized agreement, right? If you see, this term is also very important. It's a standardized agreement, right? So we know that standardized agreements are traded. Standardized agreements are traded. In this case, future are traded at the exchange, right? And that's why I said here, right? If you see this note, futures, if you see, I said futures are traded at the exchange, right? So these are standardized agreements. So let's understand some of the key characteristics. Okay. The key characteristics of future contract. Okay. First is, and this is what I said, futures contract are standardized, okay, in terms of contract size, expiry date, underlying asset, quantity, and any other variable that is left out. So future contract are standardized agreement. So when I say they are standardized agreement, I mean in terms of the size, expiration date, underlying asset, and maturity. Sorry, yeah, and maturity. Sorry, underlying asset. Okay, we have maturities. Okay, we have already covered expiration date. So it's in terms of size, expiration date, underlying asset, and quantity. Oh, size we covered. Okay, so it's okay. Okay, etc. Right. This is like the first characteristics. Second is, if you see, second is a clearing house acts as an intermediary between a buyer and a seller, guaranteeing the performance of the future contract. So see these, if you see, since it's traded over the at the exchange, and that's why all the properties of exchange are being used here. So if you see, there is a counter, there is a clearing house which acts as an intermediary between the buyer and the seller in a future contract. Future contract. This is the second characteristic. Third is, and this is like very important, this can be even asked in the interviews, that is, the future contract are mark to market daily. And this is very, very important. Okay. What does this mean? This basically means that the gains and losses are settled at the end of each trading day. Okay. Meaning the gain and the losses are settled at the end of trading day. And this is very, very important. Okay. So this is the third characteristics. Now, fourth is, now if you see the future contract, in the future contract, delivery, right? The delivery can be a physical delivery or a cash settlement. So what do I mean by this, right? So if you see, right, if you see, we have different underlying assets, right? In a future contract, what can it be? It can be anything, right? We know, like, okay, it can be stocks, indices, currencies, commodities, interest rate, etc., right? So now let's say we'll just write, okay, stocks, we have indices, currencies, commodities, interest rates, right, etc., right, etc. So we have all this underlying asset in a future contract. Now see, sometimes this the delivery of the, because if someone is buying, let's say if someone is buying, right, let's say party A is buying and B is selling. Okay. So party A is buying and B is selling. So now, of course, it can either be a cash settlement. Okay, party A, because it has to buy, it has to give the money to party B, right? So in this case, it is a cash settlement. Now, but if you see in terms of commodities, right? If you see commodities, what are commodities? Example of commodities are, if you see, oil, gold, silver, wheat, these are certain examples of commodities. So if you see, oil cannot be settled, right? I mean, it has to be, if someone is buying oil, right, they want a physical delivery of oil, right? So in certain cases, that's why I'm saying, in certain cases it can be either a physical delivery or it can be a cash settlement. So this was the fifth feature. Sixth is, and this is also very important, margin requirement. Okay, margin requirement. And we will study this in detail. Okay. So basically, margin requirement is nothing but, if you see anyone which is being involved in a derivative, there are two types of margin requirement. One is the initial margin. What do you mean by initial margin? Is nothing but traders must deposit an initial margin, which is nothing but a small percentage of the contract value, right, to open a position, or let's say, to enter into a transaction. So traders must deposit initial margin, which is nothing but a small percentage of your contract, a small percentage of the contract value, okay, to enter into the transaction. Also, and the second thing is maintenance margin. And we will study this in detail, okay? So what is a maintenance margin? It is nothing but traders must maintain a minimum margin level. So if let's say if the margin falls below this level, they must deposit additional funds, okay? So, and I'll show you with an example of what is the need of maintenance margin. So traders must maintain a minimum margin, right? So if the if the if the margin falls below the minimum margin, right, then trader must deposit additional additional fund, okay? And that's where a concept of margin call comes into place, okay? So when you're so let's say, the maintain this margin is, let's say, $1,000, right? And you have, let's say, $2,000. But let's say, because of the trading activity, we have profits and losses, right? And since I told you, future contracts are marked to market daily. So, there'll be some ups and downs in this value, right? So once it reaches this level, right? Let's say now it becomes 1,000, right? Once it goes below $1,000, that's where the exchange will say, okay, margin call. That's a margin call. So which means, okay, your margin that you have deposited has gone below this level, right? And that's why they have to put in additional margin. So that is what we say as margin call, okay? I'll show you with an example, don't worry. So that was all the characteristics of, a future contract. So let's summarize. So what are the key characteristics? First is, of course, it's a standardized agreement, and second is, it's been traded at the exchange. So we know that over the exchange we have a clearing house between the parties. Third is, if you see their futures are marked to market, then in future contract you'll have delivery. Of course, you need to deliver whatever your underlying is. So sometimes it can be a physical delivery, and sometimes it can be a cash settlement. Sixth is, of course, like the margin requirement that you have to make sure, for your future contract. And last thing which I want to say is future contracts are highly liquid. Okay, because it's been traded at the exchange. Okay, highly liquid. So future contracts are highly liquid. So let's understand what is the payoff diagram. Okay, let's understand the payoff diagram of a future contract. Okay. So, see, the thing is, of course, we know that one party will buy the contract, the other party will sell the contract, right? That's how it's the transaction happens, right? So when we say, okay, you know, one of the parties, let's say, party A buys the forward contract, right? If we say this, it means party A is in long position. So long position refers to buy. Okay. Remember this. Remember this. And then if we say, let's say, party B is selling the forward contract, right? So it means short position. Okay. This means nothing but short position. And this is basically we say, okay, it's selling. Short is referred to as selling and long is referred to as buy. How I remember is, okay, S for short, S for sell. So the opposite becomes, buy. So that's how I remember. So let's understand the payoff from a long position, right? So if you see payoff from a long position in a future contract. So the payoff equation is, okay, the payoff equation for a long position in a forward contract is nothing but ST minus K, where ST is nothing but your price at the maturity and K is nothing but your strike price. So if you remember, we said, right, I mean, okay, the derivative contracts, the we buy it at a predetermined price. So that predetermined price is nothing but our strike price. Predetermined price is nothing but a strike price. And see, we know like the underlying value of, let's say, if we are considering a stock, it can change, right? It can be anything. So that's why we say, okay, whatever the price at the maturity, that's how we'll decide whatever the payoff is. And similarly, and I'll give you an example also, don't worry. Similarly, payoff equation. And this is very important. Please remember this, okay? Please remember this. Similarly, payoff equation for a short position, right, is nothing but K minus ST. See, someone is at buy position, so just reverse the equation. Always do this. It's very helpful, right? So the equation becomes K minus ST. Or you can also write, you could have also write negative of whatever equation, payoff equation is that long position, right? So we know, okay, basically payoff equation for a long position is ST minus K. So this becomes K minus ST. Okay. So remember this equation also. Now let me give you an example of this. Okay. Let's take an example to understand this better. So let's imagine a investor enters into a future contract, right? And he wants to buy 100 barrels of oil at $70 per barrel. Okay. So let's say investor wants to buy oil. Okay. So for buying the oil, he enters into, let's say the investor enters future contract, into future contract. Okay. So he wants to buy, so the investor wants to buy 100 barrels, 100, okay, this is R, okay, 100 barrels of oil. The price that he wants to buy is at $70 per barrel. Okay. And let's say the expiry is 3 months from now. 3 months from now, right? Now, if you see right now, okay, so we have decided that, okay, he wants to buy the oil at $70 per barrel. So as I said, whenever you have a predetermined price, that becomes your K. K is nothing but your strike price, okay? K is referred to as strike price in this. I guess I told you already, right? K refers to strike price. Okay. So now if you see, right, there can be only two cases, right? There can be only two cases. Now let's talk about the solution, right? See, we know that the investor wants to buy at $70 per barrel. So either the price can increase of oil, right? Or in future, let's say 3 months from now, let's say the price can increase or the price can decrease, right? These are the only two scenarios what will happen with oil, right? So if you see, we'll take scenario by scenario, okay? Let's take our first scenario. Let's take scenario that the scenario one, that is price increased, okay? So let's say now the market price, okay? Let's say the market price of oil is $80 per barrel, okay? Now if you see, the payoff. See, even though the price is 80 right now, let's say this is basically 3 months from now. It's been 3 months that has gone by, and the price is $80. But if you remember, the investor did a deal at $70. So even though the price is $80, the investor still has to pay only $70, right? So if you see, the payoff is nothing but we know ST minus K. So if you see what is the price of our oil right now, it's at the maturity. So it's at the maturity basically means 3 months that has gone by, right? So it's $80, right? And what was our strike? That is $70. So basically, if you see, the investor was able to gain $10 per barrel, right? This was this was his profit, if you see, right? And let's say if let's say we did not we also said here that he wants to buy 100 barrels of oil. So if you see here now, because this is per barrel and or the investor wants to buy 100 barrel of oil, right? So if you see, in $10 which was per barrel, now we are doing this, multiplying this by 100, so this becomes $1,000, right? So in a way, because of this future contract, he was able to make $1,000 on the deal, right? So if you see this equation, which I said, only one thing which you need to add is this whole multiplied by the quantity. Okay. So this whole multiplied by the quantity. And similarly, if you see here also, it will be same, right? I'm just removing this. Yeah. So this multiplied by the quantity, right? So if you see, this was the scenario when the price went up. But let's say the price decreased. Okay, let's take the second scenario. That is scenario two, that the price decreased, right? So let's say right now the market price of oil per barrel is, let's say, $60, right? And still, because we already did a contract that we'll buy it at $70, right? So if you see, the payoff is nothing but, as I told you, payoff is nothing but K minus ST, right? Oh, sorry. Yeah. So if you see, because we know at expiry that the market price is $60, right? So this multiplied by the quantity. Okay, one thing which I want to say, okay, because we are looking from a buyer's perspective. Sorry, then this will be ST minus K times quantity, right? So what is ST? ST is 60 minus 70, right? Right now the market price is 60, predetermined price is 70, and we know quantity is 100. So if you see, this is nothing but negative of $1,000. So basically, if you see, From this, we understand that, okay, the person, the lost the money, investor lost the money by entering into the forward contract. So as I said, the investor can either make the money or it can lose the money. These are the only two scenarios, right? So always remember, if in a long position, if let's say then someone is making profit, so in the short position, the investor, or let's say the party will be making loss. So whatever profit he is making, similarly the same loss this party will be making. That's why it is called. So let's say if in the long position the party made $1,000 profit, so in the short position the party made $1,000 loss. And if we add this $1,000 minus $1,000 is equal to zero, right? So that's why you will read a lot of times that derivatives is a zero sum game. Okay, you will read a lot of time derivatives is a zero sum game. What does this mean basically is, okay, whatever loss someone is making, equal amount of profit the other part is making. So this was more from a example perspective, right? But as I said, things to remember is, if you are in a long position, your equation is st minus k, and if you are in a short position, equation becomes k minus st, right? This is the summary of it. And okay, so I was also asked this question in the interviews, okay, what is, the payoff, and can you also draw the graph for it? So this was one of the questions that I was asked. So let's understand the graph, right? So in our case, let's take st, let's take k, and let's take st minus k, which is nothing but our payoff, right, from the future contract. So let's take because in our case, we had the predetermined price was 70, right? So let's take the values goes between 65 to 75, okay? 71, 72, 73, okay? 74, 75. So now we see as we know, the predetermined date will remain the same. That is, the strike price will remain the same. So now if you see, right, ST minus K, what is ST minus K? So ST minus K is nothing but your 65 minus 70, that is -5, -4, -3, -2, -1, 0, then 1, 2, 3, 4, 5. So this becomes your payoff. So when you plot it, so when someone says, okay, can you plot the diagram? So it will be something like this, okay? So as we know, uh, so if you see, the stock price will come here, 65, 66, 67, up till 75, right? This is, let's say, 70, okay? Similarly, so we know that ST minus K is nothing but, at 60, the loss was -5, right? So 0, -1, -2, -3, -4, -5. So similarly, right? Um, okay, one more thing. I didn't do this equally, right? Let me draw this equally. So 65, 66, 67, 68, 69, 70, let's say this, okay? So we know that at -5, sorry, at 65, the payoff is -5, right? So at 65, payoff is -5. Similarly, -4, -3, -2, -1, 0. So if you see, right, it will be basically a straight line. Okay, this will again be 1, 2, 3, 4, 5. So this is how a payoff diagram is for a long position, right? So as I said, so what will be so this is how the payoff diagram look like for a long position in the future contract. Similarly, for a short position, we know that the formula is nothing but K minus ST, right? So basically what we can do is we can copy this. Okay. So if you see, we know the payoff for a short position is nothing but K minus ST, right? So in this case, K is nothing but 70. 70 minus 65 is 5, 4, 3, 2, 1. Here it will be 0, 1, 2, 3, 4. And then here will be 5. So if you see the payoff diagram, how it will look like is something like this. We'll again plot this 65, 60. We'll plot the stock here, payoff diagram here, right? See, where I say ST is ST can be any underlying stock, bonds, currencies, anything, right? 65, 69, 68, 69, 70. So if you see at 65, the profit was 5, 4, 3, right? So we'll just basically plot a diagram 5, 4, 3, 2, 1. This is 0. Then 71, we have a negative profit. So we have a loss, right? So the payoff diagram will look something like this. Okay, don't sorry, I mean, yeah, this yeah. So something like this, right? So this is how a payoff diagram for a future contracts look like. Now let me show you a practical example of, in Excel. If someone asks you, okay, can you basically plot a example of it? So let me share an Excel with you. Okay. Just let me know. Is the screen? Can you see the screen? Okay, perfect. So as we know, in a futures contract, the payoff is nothing but ST, like whatever stock whatever price you have for the underlying at the maturity, minus your strike price. That is your predetermined price, right? So I'm just using the same. I'm just using the same formula downwards. And if you see, we got a very similar graph what I just showed you, right? And similarly, if you see payoff diagram for a short position, we know what is the payoff equation, that is K minus ST. So K minus ST. So if you see, I'm just dragging this formula, and if you see this, basically we got a very similar graph, right? So if you see, this is how we basically draw a payoff diagram for a long position in futures, or let's say a short position in futures. So I hope this is clear. Let me now share, okay, let's move on to what is a forward contract. Let me share my screen again. Okay. So let's understand now what is a forward contract. Okay, now if you see a forward contract, it's a customizable contract which is traded over the counter between two parties to either buy or sell the underlying asset at a specified future date for a predetermined price. So if you see, unlike the standardized future contracts, forward contracts are tailored to meet the specific needs of the parties involved. So a forward contract is being traded in over-the-counter market, usually between two financial institutions, or it can be between a financial institution and one of its client. So, so a forward contract is a customizable customizable contract which is traded over the counter. A forward contract is an agreement between two parties to buy or sell an asset at a predetermined price, also at a predetermined date. Okay. So a forward contract are tailored. So forward contracts, okay, the forward contracts are tailored. So a forward contract are tailored to meet the specific needs of the parties involved. So that is why, the forward contracts are customizable. These, if you see, that's why I've written these are if you see, these are customizable contracts, which basically means, okay, it can be customized depending on what is the requirements of the parties. Okay, and that is why one of the reason is forward contracts are being traded over the counter, because we know at over the counter, whatever the instruments are traded, those are customizable contracts. So now a forward contract is traded in over the counter market, usually between two financial institutions, or let's say it can be between financial institution or and its client. And its client. It can be either of them. So let's understand some of the key characteristics. So if you see a forward contract, right? So the terms of forward contract, including the quantity, quality, price, delivery date of the underlying assets, those are customized depending on what are the requirements of the parties. Okay. So the term of a forward contract, what are the terms? It can be, quantity. So when I say quality, right, let's say cotton, if you see cotton, the cottons, there are different qualities of cotton also, right? And same goes for different commodities. If you see oil in nature, they have different quality. So depending on what is the quality that what is the requirement of the parties, it can be changed, right? So quality, quantity, price, you know delivery date, these can be customized depending on the requirements of the parties, depending on the requirements. So this is the first feature, or let's say this is the first characteristic. Second, again, as we know, the underlying asset in a forward contract can either be a physical commodity, or it can be a financial instrument. Okay. So we know that the underlying instrument, or like the underlying asset, it can be basically, it can be either, let's say, a physical commodity. As I said, wheat, oil, cotton, these are some of the commodities, right? Or it can be a financial instrument. So these are, different underlying that. See, whenever you study a forward contract, right, in the contract, there'll be a lot of things mentioned. So, one thing, one of, there will be some terms mentioned. And then what is the underlying asset that has been, given to you, to the parties is been mentioned. Now, delivery will be mentioned. Okay. So is it a physical delivery? So in terms of, if you see if it's a commodity, then definitely it will be a physical delivery. Or is it a cash settlement, right? Yeah. So so these are certain things which will be, some of the characteristics which you will see in a forward contract. Also, one more thing is, if you remember futures, they were marked to market daily. But if you see forwards are priced only at the maturity. Okay. And because of this reason, right? Because of this, just because of this, there is no margin requirement as such. Okay. So because the forwards are priced only at the maturity, right? So there is no there's okay, there is no margin requirement. Again, see, because these are customizable, right? So if the parties want, like, if one of the parties says no, we want requirements, we should, both of us should post the collateral, right? Or we should basically we should basically have something in place so that there's lesser counterparty risk, right? So it can change it, because it's a customizable contract. It can change, the different terms and conditions. And last thing is, since there is no clearinghouse in between, then because of this, we forward contracts have higher counterparty risk. So let's understand the payoff. Okay, payoff from a forward contract. So it's the same, it will be the similar as what we saw in futures. So if someone is at a long position, the payoff, okay, the payoff for a long position is nothing but ST minus K. And similarly, if you see for a short position, it will be K minus ST. So the equation remains same. And again, we multiply with the quantity. Q is nothing but a quantity, right? Okay, ST is nothing but price of the underlying at maturity. And then K is nothing but your predetermined price. It is also called the strike price, or you can say it's the predetermined price. So someone who's in a long position in a forward contract, this will be the payoff equation. While someone who's in the short position in the forward contract, this becomes the equation. And also just remember, long is nothing but negative of short. This just remember this. Okay, what if you are getting profit here? The equal magnitude you'll get the loss here. So that's why we said it's a zero sum game. Again, if you see, the payoff diagram will be, if you see, if someone asks you to draw the payoff graph, as I showed you above. So for a long position, it will be like this, you know, and similarly for a short position. And also remember, here you will have your payoff. This is zero. Here you'll have your payoff. and here you will have your price, your ST. Okay, different price at the maturity, and this is K. Okay, similarly, if you see for a short position, this is ST, this is your payoff, 0 K, right? And then you'll have something like this, right? So this is one of the example, okay, of uh, how to draw the graph. Also, do you want me to give an example of a forward contract?
No, I think you
Yeah.
have that on your question and
Okay. So yeah, because
uh, uh, your
yeah,
interview question. So I think we can refer that.
okay, because the equation remains the same, right? So the if you see the equation what we saw in the future contract, so similarly if you see in a forward contract, the equation will remain the same. So that's why the payoff diagram for a future and a forward is same. It's just the terms and conditions and the features of the contract that will differ. So I'll give you a quick example. I'll show you a Excel implementation which I developed for a forward contract. Okay. Can you all see my screen?
Yes.
Okay, perfect. So if you see as we know, okay, the equation remains the same, which is nothing but ST, okay, ST minus K, right? And this is for a long position in the forward contract. And I'm just dragging down the formula. Now, one more thing. I said you, okay, we are also multiplying the quantity. So as of now, in this, I was taking, okay, we have one quantity, but let's say we have 100 or let's say 10 quantities of it, and let's drag the formula. So if you see, only the scale changes, right? The diagram will just remain the same. It will be a upward line, but only the scale will change here, right? So similarly, if we see this, the payoff diagram for a short position, which is nothing but K minus ST, right? And if we plot this out, and okay, let's include, okay, quantity, similar quantity, which is 10. So now if we plot it, see, irrespective of the quantity, as I said, the plot will just remain the same. So it's only the magnitude of your payoff that will change, but the plot will remain the same. So that was it. And let's study the third derivatives, which is nothing but options. Options are used a lot. So let's try to understand, okay, what is option, and how to price. Let's say what is a call option, what is a put option, how to basically price, or let's say how to calculate the payoff diagram of a call option and a put option. So the third kind of derivatives is nothing but options. Okay, so let's understand what is this option, right? And why they are used when we already have forwards and futures. Why are option used? So basically, options gives the holder the right, but not the obligation to buy or sell an asset at a predetermined price at a predetermined date. So if you see, options gives the holder the right, but not the obligation. And this is very important. Okay, and this is what it is and this is what why options are different from forwards and futures, because it gives the holder the right, but not the obligation to buy or sell an asset at a predetermined price at a predetermined date. So when I say it gives the holder the right but not the obligation, what do I mean? If you see forwards and futures, right? I spoke about two scenarios, right? In which the investor was making profit and in which the investor was making loss. In both the scenarios, the investor has to, obligate the contract, you know. So in forwards and futures, the parties have to obligate the contract irrespective of whether they are making profits or losses. But in options, it is not the same. So if let's say let's say I'm buying this derivative, which is I'm buying the option, and let's say if I'm making a loss, I'll say okay, I don't want to, I'll just back out. I'll just say I do not want to obligate the contract. Okay. And that is why we always say, okay, the options are not an obligation. You can back out of the contract. So that's why it gives the holder the right to buy or sell, but again, it's not an obligation. Okay, not an obligation. So now we have different types of options, and you might be thinking, okay, so when someone how will we decide whether someone can obligate the contract, whether someone can't obligate the contract, right? Because if you do not obligate the contract every time, so for the other party it's a loss, right? So let me help you understand this. Okay. So first, before going into detail, let me help you understand what are the different types of options. So as I said, there are different types of derivatives: forward, futures, options, swaps, and in options we have different types, that is call and put options. Okay. So types of options. So the first is call option. The second one is put option. Okay. So let's understand what is a call option, what is a put option. So basically a call option, right? If we see a call option, it gives the holder, right? It gives the holder the right to buy, the underlying asset at a at the strike price. Or let's say we can say, at the given um, predetermined price that we have chosen in the contract, right? So you might be thinking, okay, so it gives the holder the right to buy, right? So when will someone buy it? So of course, the expectation of the holder will be the price, you know, the price of the underlying asset will increase, right? So also remember when nothing is mentioned, okay, because call option, right? This has been traded between two parties, right? So of course, one will be buying this contract, one will be selling this contract, right? So if you are buying this contract, you will be called as you are someone in the long position, and similarly, someone who's selling the contract will be said as in a the investor or the person is in a short position. So if nothing is mentioned, always make sure it's a long position. Okay. So basically, when I'm buying, let's say the call option, when I'm buying the so call. Okay. So as I said, what does call means? Call means okay. Call means to buy the underlying. Okay. Why will you buy? Because you know that the price of the underlying will increase, right? That's only when you buy, right? But similarly, if you see the person who's selling the call option. So just imagine, no, I mean, why will someone sell it? Okay, I want to sell something. Why will I sell it? Because I know, I mean, if I keep this for a longer time, I will face a loss, right? So here the expectation is, so someone who's entering as in a short position in a call option, right? So his expectation is, okay, okay, just give me 1 second. Yeah, here the expectation is the price of underlying will decrease. And this is very common now. I mean, someone who's, let's say, we are buying, let's say, a stock. Why I'm buying the stock? Because I know the price of the stock will increase, right? And that's why I'm in a long position. And let's say, why will I sell the stock? Because I know in future the price will decrease for this specific stock, and that's why I'm selling it. So similarly, it is in this case okay, so call option basically means you are buying it. Okay, you are buying the underlying. So when I say, okay, I'm long in the call option, it basically means I'm buying it. When I say I'm short in the call option, it basically means I'm selling the underlying. Okay. So basically, long call means buying the underlying, and short call means selling the underlying. But before diving deep into this, right? What is how people make a profit and stuff like that, let's understand some of the key characteristics. Okay, so I guess I should have told you the key characteristics above only, but no worries. Okay, let me first tell you the key characteristics. So the way it should be defined was key characteristics, then what is call option, put option, but no worries. So let's before understanding what is a put option, let me tell you what are the key characteristics. So if you see, the key characteristic will be the underlying asset, as we all know, and it can be different financial instruments, stock, commodities, currencies, indices, right? Then the second is strike price. Strike price is nothing but the predetermined price at which you want to buy the underlying, right? Third is premium, and this is like very important. Okay, so premium is nothing but the premium is the price paid by the let's say buyer to the seller. Okay, okay, so this is what we say as premium, the price paid by the buyer to the seller. Okay, and this is always the case. So basically the buyer will pay the premium and the seller will receive the premium. Always, this is very important, guys. Okay, there's one more concept which okay, I'll cover it. Okay, the fourth characteristics is expiration. When is, or let's say expiration date, which is nothing but when is your contract about to expire, right? And the last is the exercise style, and this is also very important. Exercise style basically means you can exercise the contract at the expiration date. So either you can exercise the contract at the expiration date, and such style is also called as European option. Okay, so when someone says, oh, it's a European option, it only means one thing, that you can exercise the contract or you can exercise the option only at the maturity. Okay, or let's say only at the expiration date. Similarly, if you can exercise the contract anytime in the life of the option. So this style is called the American option style. So when someone says, oh, this is an American option, that basically means that you can exercise this option contract anytime. Let's say even if the expiry is 3 months, let's say, even if let's say, we are standing here at time zero. Let's say this is the 3 month expiry of this contract. Even if you think at this point, that is 1 month, assuming, okay, you think, okay, if I execute this contract, I can make profit. So you can do it. So this style is nothing but American option. But with as I said, with when the information is okay, you can only exercise at the maturity. That is what we say as European option. So this is the American, this is like the style of the exercise, and these are the important characteristics. Okay, that is okay. What will be the underlying asset? Strike price, premium. Always remember, premium is nothing but the price paid by the buyer to the seller. So buyer will always pay the premium, seller will always receive the premium. Expiration date, exercise style. So these are something that are mentioned in the in an option contract. So now, as I said, if you just want to revise, what is an call option? Call option basically means you have the right. Okay. So when I say the holder, right, it basically gives the right to the holder to buy the asset. Okay. So now you can be in different position, because call option is nothing but a derivative contract, right? So you can be in a long position, or you can in a short position. So long position means you want to buy the underlying, short position means you want to sell the underlying. Okay, so let's see what is a put option. Or okay, before going inside the put option, okay, I want to walk you through what are the payoff equation for a call option. Okay, payoff equation. So for a long position, okay, in a call option, right? So in a long position of the call option, the payoff equation will be this: maximum of st minus k comma 0, right? This will be the equation for a for a long call option. Similarly, if you are in a short position in the call option, also one more thing which I want to include here, right? See, this is basically the payoff equation. We also know that the buyer, long is what? Buyer, right? The buyer has to pay the premium, right? So minus P, where P denotes premium. So this will be your complete equation. Similarly, for for a short position, we know that the seller will receive the premium, right? Plus, and we all know we'll just take negative of this part, right? So it will be plus minus is nothing but no, negative. So this is nothing but negative of maximum of st minus k comma 0. Okay, so this will be your short position of the this will be your payoff equation for the short position. So as I said, when will someone buy, when will someone go into the long position? When is the investor will buy the long call when they expect the price of the underlying to increase. Similarly, in when will someone go in short call? When they expect the price of the underlying to decrease, right? So, and okay, so also one more thing which I want to say is, in this class we'll be only covering call option, and in the next class We'll be covering what is short, what is put option and other stuff. So as we know, okay. So if you see this, if you see call option and put option, right? Let's understand the payoff. Let's draw let's draw the payoff diagram. It's also called payoff diagram, okay? So ST, you all know, K and payoff, which is nothing but okay, one more thing is premium, ST, okay, and your payoff is nothing but maximum of, this is for a call option, okay, maximum of ST minus K, and you have to give the premium, right? So we can take, let's say we can take several values. Let's say this is 95, 90, 91, 92, up till 100. And similarly, we have 95 up till 100. Let's say we pay the premium, okay? $1 is the premium, okay? And I'll also explain you why the premium comes into the play, okay? Let me first help you with the payoff, and then I'll tell you the reasoning, why someone has to pay the premium. Let's say why the long position has to pay and why the short position has to receive it. Okay, so if you see maximum of ST minus K 90, oh sorry, so maximum of ST minus K comma 0, right? So maximum of ST is 90, 90 minus 95 comma 0 minus 1. So this will be what? 90 minus 95 is -5. So maximum of -5 comma 0 is 0. So 0 minus 1 is -1. So similarly, we'll have maximum of 91 minus 95 comma 0 minus 1, right? So, so this will be nothing but, if you see, -1, because 91 minus 95 is -4. Maximum of -4 comma 0 is 0. 0 minus 1 is -1. So similarly, up till you go till let's say 90, let's take this value as 96. Okay. So at 96, what will be the payoff? So what will be the payoff? Next 96 minus negative 95 comma 0 minus 1. So 96 minus 95 is 1. Maximum of 1 comma 0 is 1. 1 minus 1 is 0. So from till, if you see this, so it will be -1 up till this point. And at 96, your payoff will be 0. And then after this, your payoff will start increasing. So if you see maximum of 97 minus 95 comma 0 minus 1. So this will be nothing but 2 and 2 minus 1 is 1. So similarly, the payoff will start increasing. So now when we plot the diagram, right? So now when we plot the diagram, it will be something like this, -1. So if you see, and then it will go like this. So this is how, with this calculation, right? With this calculation, that's how the payoff diagram is being generated. So at 96, so this is 96, this is 95, right? So from 90 till 95, the payoff is -1, right? At 96, the payoff is 0. And then after this, we'll start generating profit, right? So, so just a quick reminder at, okay, so 90 to 95, the payoff is -1. At 96, the payoff becomes 0. Greater than 96, we start generating profit, right? So now if you see, right, this is how the payoff diagram for a long position in a call option look like. And similarly, you will use this equation, that is premium minus maximum of ST minus K comma 0, right? For this is the equation for the short position in the call option, right? And you will see a graph something like this. Something like this, okay? So this is how the graphs of call and put option looks like. One last question which I want to tell you is, in an option, right? I said, okay, basically it's, it's the right of the holder to buy or sell, but not an obligation, right? What do I mean by this? It's not an obligation. Okay. Let's take a example to better understand this call option. Let's say a farmer, or let's say a investor wants to buy a stock, wants to buy a stock at a predetermined price of $95. Time is nothing but 3 months from now, and it's a European style option. Okay. And we know it's a call option. Okay. It's a call option. So now if you see the stock value, right, at the maturity. So we are saying at this time, I will buy the stock at 95. Okay. This is what the investor wants. Now there can be, as I said, there can be two scenarios. Either, let's say the stock price at the maturity, the stock price at maturity is, let's say, $90. So, and stock price at maturity is, let's say, $100. So when it's $90, right? So if you see, right, the investor has said, okay, I'll buy the same at 95, right? So this is the situation. These are two scenarios at the maturity, but we know, okay, the predetermined price is 95. So if you think in this case, right, in this case, if I'm getting something at 90 from the market, and I have said, okay, in the contract, I have mentioned, okay, it's 95. For me, it's a loss, right? I mean, if you think because I can get the same thing from the market and at 90 and $90, but I'm still giving $95. So, right. So as simple as, okay, Apple stock is listed at, I had a deal of buying it at 95, but I see in the market it's at $90. So for me, it's a loss, right? In this scenario, the investor has to face a loss, right? So when something like this happens, investor can back out. So investor can back out. So the investor can say, okay, I do not, or let's say the parties can say, okay, I do not want to obligate the contract, and that is why this is what the additional feature is, right? If you see in forwards and futures, we studied, okay, the parties have to obligate the contract, but in this scenario, the party can say, okay, I do not want to obligate the contract. So in this scenario, what will happen is the party will just pay the premium, okay, and will say, I do not want to obligate the contract. That's all. And that's what makes options very famous, right? If you think, okay, I can generate a loss, I'm generating a loss, I'll just say at the maturity, I do not want to obligate the contract, I can just pay the premium and leave this thing as it is. Let's say if you are at $100, right? If let's say the stock of Apple is listed at $100 at the marketplace, right? And you are getting the same thing at 95, of course you will execute the contract, right? It's a win-win deal, right? For you, it's a win deal, right? You will execute the contract in this place, right? So 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 in this case, if you see, the buyer has backed out, and in this case, the buyer has basically executed the contract. So one more thing, and this is like the most important thing, right, which I want to tell you. Buyer has the right to either, let's say, execute the contract, or he can back out of the contract by just paying the premium. Let's say by paying the premium, okay? So when I say buyer, I mean the person who's in a long position, okay? Someone who's in a long position in a call option. Okay. But if you see the seller of a call option, basically, if you see who's in a short position, right? Seller is nothing but someone who's in a short position. He always has to like the seller always has to obligate the contract. Always has to obligate the contract, irrespective of profit or loss. So irrespective of this, the seller always have to obligate the contract, and this is what the main difference is. That's why you will see most of the investors, they are into, or let's say most of the parties, they are into the long position because they can back out of the contract. So someone who's in a short position always need to think, because the short position always has to execute the contract, right? And if you see the payoff equation, right? If you remember what was the payoff equation, see, because it's a short position, right? And the seller always has to obligate the contract. So of course he will receive premium, right? Premium minus maximum of st minus k comma 0. This is the payoff equation, right? So now when you let's say draw the diagram, okay, and I'll also show you with the Excel, and then we can complete the class. So if you see, the payoff diagram will look something like this. Okay, when you use this equation to plot the diagram, it will look something like this. Whereas, so this is for a short position, and if you see for a long position, it was something like this, if you remember, right? So how will you interpret this? If I ask you to interpret in the short position, right? Loss is the profit is capped, but but there can be infinite loss, right? And that's why short position is very risky, because if you see, the profit that we are making is capped. We are not making unlimited profit, but the loss that we can make is unlimited. Whereas in the long position, the loss is capped. If you see, we have a constant loss, right? Loss is capped, but loss is cap basically, I mean, it is cap and floor is used differently, but what I'm saying is loss is constant. Okay, yeah, let's put a better word. Loss is constant, but profit is unlimited. The profit is infinite, right? That's what make this long position very attractive and the short position less attractive. So if you see, profit is constant here. So I hope you understand this, the risk. Basically, always remember, I just want to summarize. So someone option is nothing but it gives the right to buy or sell, but again, it is not an obligation, right? It is not an obligation. So the buyer of the contract, someone who's at a long position, can either let's say obligate the contract, or he can back off. He can back off of the contract, but someone who's at a short position always has to obligate the contract. And this I'm referring to with respective to call. Okay, so this is with respective to a call option. Okay, so that is summary. So buyer always has the right, but it's not obligated, but seller is always obligated. Now I'll just show you a quick example in Excel, and then we can wrap up our class. So can everyone, sorry, um, can everyone see the Excel spreadsheet?
Yes.
Okay, perfect. So now if you see, okay, at the maturity, as we know, the stock can take multiple values from 90, let's say, it can take 90 to 100. And similarly, because we have said, okay, we'll buy this at a predetermined price, okay? And the premium is 1. Okay, we are paying the premium is 1. So I've just integrated this formula, which is nothing but maximum of st minus k comma 0, right? So 90 minus 9, 9 max, so we are subtracting 90 with 95, and then we are just checking what is the maximum, this value or the zero value, right? And then we are just subtracting the premium. So this is the formula that we are using, right? And then we are just dragging in the formula, right? So this is how the the graph payoff graph looks like. And I'm telling you, this is something that is asked over and over in the interviews. Can you draw the payoff diagram of a long call, short call? Okay. So if you see, our losses are constant, which is -1, but profits can be unlimited, right? If this value goes to 120, right? So the profit will just rise and rise. And similarly, if you see a short position, right? As we know, the short position is nothing but the seller will receive the premium, and then we just need to take the negative of maximum of st minus k comma 0, right? So if you see this, I've integrated this formula, that is premium, which is $1 minus maximum of st minus k comma 0, right? So if you see, right, and I just drag down this formula, right? So if you see, we have a constant profit at $1, but the losses are infinite, and this is what makes the short position less attractive and the long position more attractive. So that is all about the class. In the next class, we'll be covering about what is put option, how to go long and short, the payoff diagram for a put option, and we'll be covering chapter two, or I believe chapter one. There are few parts which are left out, uh, so I'll be covering that using the Excel implementation only. So yeah, any other doubts you have? Please feel free to ask any doubt if in case you did not understand anything. Okay, so thank you all for joining in today. Will from the next class, as I said, we'll be covering the put option, and we'll be seeing what is the payoff diagram, and we'll study what is speculation, what is hedging, what is arbitrage, how to use these things with respect to options in general, and we'll cover different concepts and derivatives. So thank you all. Just want to make sure we are using John C. Hull for the lecture series. So please read John CL, and if you have any doubt, please let me know. Thank you.
Thank you so much, Mia.